Jere, good to see you. Today we are talking about 76 years of headlines, what market history teaches us about staying invested. Good to see you.
Good to see you, Erin.
All right, let's jump in. From oil embargoes to global pandemics, the S&P 500 has endured decades of uncertainty and come out stronger over time. So let's break down the data and talk through whether pre and post retirees should make any changes to their portfolio. And I want to start
Sounds
with
good.
this chart. So when you take a look at this, what stands out to you about how the market responds to global events?
Two things jump out at me about that chart. Number one, you can see that global capitalism is a good way to grow money, and that capitalist markets are going to go up over time. So just buying a cross section of capitalism through a mix of different companies or indexes is really a great strategy to grow money. The second thing that jumps out is with that strategy, there's volatility along the way. There's big peaks and big drops. So while it's a good way to grow money in the long term, you have to be really conscientious of the volatility that it takes to get there.
Right. And I understand zooming out, it's easy to see that staying the course, staying invested is often the best advice. But if I feel uneasy about how I'm invested, when is the right time to make changes to my portfolio?
Yeah, especially for this generally comes up for pre-retirees and retirees. And the answer there is if you're feeling uneasy, it's already too late. You should have been doing something earlier. You need to have a plan so that you can erase that uncertainty, that uneasiness, and the money you do have in the market, it really needs to be able to be there and be positioned for the long run.
And you kind of just touched on this. Volatility isn't necessarily bad for younger investors, but how is this advice different, staying invested for people who are in that retirement red zone?
So for people in that retirement red zone, the misconception here really goes back to a buy and hold strategy, stay in it for the long run. That's a good strategy for almost all of your money, if not all of it in some cases when you're younger. But how that changes for pre-retirees and retirees, it's still a tremendous strategy. A buy and hold, invest in an overall cross-section of global capitalism, but it's only appropriate for a portion of your money at that point. And at some time, as you phase into retirement, you need to switch that strategy. And get some that's not at risk of that market volatility.
Right. And we're going to dive into more specifics. And I feel like part of the conversation, we have to talk about sequence risk, right? For people who are recently retired, a down market presents a very unique challenge. Can you explain this risk?
Yeah, certainly, Erin. There are, and this chart is very helpful when you pull this up. When I look at the sequence of return risk, like all of us, we all know what the market is going to do. The stock market can only go three ways. It's going to go up, it's going to go down, and it's going to go sideways. What we don't know is when are we going to have an up year, when are we going to have a down year, and when are we going to have a sideways years. And there's lots and lots of combinations, millions literally of combinations of how we can average 4 or average 6 or average an 8% return. What we don't know is if we're going to have a positive this year or a negative this year or a negative next year, a positive next year, and what the combination of positives and negatives are. So the analogy we use to teach this as pre-retirees and retirees plan for retirement is what we call the hazard zone. So if we get the wrong sequence of returns in that early part, a couple years before retirement to when RMDs start, I call that the hazard zone. And I just imagine, I teach this as if we're driving down the highway, a 4-lane highway, we have the cruise set, 2 lanes of traffic are going well, cruise is set at 75 and life is good. Then all of a sudden we see the hazard zone coming up. The orange barrels pop up, the flashing lights and the signs, and all the traffic is down to 1 lane for that 8 to 10 mile stretch. And then we're clear of that and we're back and the road's open. So that's really how we have to approach retirement, is that hazard zone, that the years before and the early years after retirement, to manage that hazard zone extremely well, especially during periods of market highs like we're having right now.
Right.
While it's a tremendous opportunity, we have a tremendous opportunity with the wealth that's accumulated, but we have a risk on the backside of that of if the markets soften and we have a setback or a pullback, that could mean the difference between a successful retirement or not retiring at all.
Right. And so this begs the question, how then do you guard against sequence risk? Because we all want to retire. When we want to retire, we have no control over what the market's doing.
So it first starts with a plan. And one of the other things that is really interesting is people focus all too often on returns more than planning.
Mm-hmm.
So with this sequence of return risk, it's number one, it's very, very hard to even beat the S&P 500. And even if we would beat the S&P 500 by a 1 percentage point, people can still run out of money during retirement if we get the wrong sequence of returns. So we need to start with an overall plan, number one, and then start with a strategy that you only have money in the market, which is you're seeing here, the 3 buckets, or the growth section. So as we approach retirement, we need our money to grow. We need it to be protected, and we need liquidity. We need all of those things happening simultaneously that we didn't really need happening as much. We just needed growth as we got to this point. So the idea here from the investments themselves is anything you will put your money into, by and large, can be attributed to these 3 buckets or categorized into these 3 buckets. So not only do you want to get the buckets structured appropriately, you need to get the buckets rebalanced as time goes on, depending of your tax planning, your income needs, your legacy. So not only is it part of an overall plan, but the investments need to be, into the buckets categorized as well.
Mm-hmm.
So another way I say this is it's always the right time to fund your buckets. So if it comes back to that uneasy feeling, if you're already feeling uneasy, it's probably too late. You should have done something already. And you need to make sure that you readjust as time goes on. You never want to time the markets. You always want to be readjusting and funding your buckets appropriately.
Right. That's such a good reminder. Even if we think we have a plan, it's a constantly moving target that we need to be reassessing, including how we feel in the moment, which is a lot to balance at once. But Jere, as you mentioned, it all starts with having that plan. So if somebody would like to sit down with you, if they're feeling uneasy, they want that plan, what's the best way to reach you?
Yeah, best way is our website at NorthernWayWM.com.
Great. Jere, thank you so much for your time today. I really appreciate it.
Thank you, Erin. We'll see you soon.